With interest rates rising quickly and an intense bout of inflation on our hands, not to mention the ongoing war in Eastern Europe, we're starting to hear the R word, recession, creep up in more conversations. And that's just not in our conversations. Look at the Google search activity for the word recession, quite high, though off its recent peak over the past year.
Because recessions are generally not fun times for the economy or for investors, we want to be communicating with you early and often about where we think we are in relation to a recession, what does that typically mean for the markets and the economy, and what should we be doing, if anything. To be clear, we aren't currently in a recession, and we don't believe one is on the horizon. But if the data changes, so will our perspective.
We'll be revisiting this topic in the coming months, probably more than you want to hear about. But when the word recession is splashed across every newspaper and screen you look at in the bright red banner, we will be prepared. We don't need clicks. We don't need you to be on high alert. We need you to be well informed. So let's get into it.
The first place to start is with the Conference Board's leading economic index, among the most reliable gauges of turning points in business cycles. The LEI has 10 subcomponents that contribute to this broad index's ability to signal when economic activity has reached a peak, trough, or slowdown. And this is a good time to remind ourselves the stock market is not necessarily the economy, meaning they don't necessarily go up and down together like clockwork. And when it comes to the relationship between the two, better or worse tends to matter more than good or bad. So even if a particular economic indicator is strong, if it's getting weaker, that could contribute to a weaker stock market.
So if we look at the most recent data as of February 28th, 2022, the latest reading of 7.6% is strong relative to history, though off the boil of 12.3% in April of 2021. We can see this historical average reading in the month prior to past recessions going back to 1960 was a minus 1.4% level. Averages can be misleading, so we shouldn't rely on that number as set in stone, but it does give us a frame of reference. The range of LEI readings the month prior to recessions has been from minus 6.1% in the early 80s to positive 2.1% in the early 60s. For now though, the most current reading of 7.6% tells us, for now, there may be still a good amount of runway left.
Let's peel back one layer of those LEI subcomponents. As we mentioned earlier, better or worse, the trend is often more important than good or bad, which is the level. So again, what we see here are strong levels with weakening trends. What typically happens is the trends move over to the levels of the leading economic index components, then those levels move down to the coincident or current economic index.
All right, what is a recession actually? The official arbiters of US recessions is the National Bureau of Economic Research. They define a recession as a significant decline in economic activity that is spread across the economy and that lasts more than a few months. The definition you'll hear on the news is 2 quarters in a row of negative GDP growth. Although many believe that is the conventional definition. It isn't the real one.
So the NBER primarily monitors the components of the CEI, the coincident economic indicators we just touched on. And their assessment is always made retroactively. For example, it wasn't until July of 2021 that the NBER officially determined the COVID-era recession ended in April of 2020. Again, while it's tempting to find comfort in the strong data, reality is deterioration in trends often lurks in the background and can spread rather quickly. So far, so good, but we want to start trading the level mindset and instead focus on the trend.
Now let's turn to consumer confidence. Consumers consume, right? Consumption represents about 70% of US GDP, so it's something to keep an eye on. Whereas the monthly headline Consumer Confidence Survey is interesting, there is a sub-question about consumers' present situation confidence versus their confidence about the future, called expectations. Looking at future expectations versus their present situation has never been this low in history without a recession, either pending in short order or already underway.
One question that always comes up in the recession conversation is, yeah, but unemployment is so low, how could there possibly be a recession? And it makes sense. If consumption is so important to our economy, and when people have jobs, they probably consume things, then how could there be a recession? Key here is unemployment rate is one of the most lagging of all economic indicators. The unemployment rate has always been near its trough each cycle heading into recessions. A rising unemployment rate doesn't cause recessions. Recessions cause the unemployment rate to rise. Recessions have always ended with unemployment near its peak, and in many cases, it still continued to rise after recessions had ended. Looking at this table, again, we see the unemployment rate prior to the recession start is quite low, and only very slightly increases during the month the recession actually begins. Bottom line, don't take economic turning point cues from lagging indicators.
Turning to the yield curve, a lot of armchair economists and recession forecasters out there use the yield curve inversion as an indicator. Why is that? Well, first, what is a yield curve inversion? Just like how a 15-year mortgage rate is lower than a 30-year rate, same thing all across the bond spectrum. If we're going to tie our money up for longer, we would expect to be compensated for that. And when it comes to bonds, that extra compensation comes in the form of higher yields. So a normal yield curve is upward sloping, where the shortest maturities offer the lowest yields, and the longer maturities offer the highest yields. So when the yield curve inverts, it's actually the short maturity bonds that have higher yields than longer dated bonds.
For today, we won't get into the underlying reasons behind that, but inversions themselves have historically been a reliable precursor to recessions. There are two main pairs people watch: the 10-year Treasury minus the 2-year Treasury, and the 10-year Treasury minus the 3-month Treasury. Yield curve inversions are often viewed as a cause of recessions, when in fact they're better thought of as a symptom of the conditions that tend to lead to recessions. And you better believe it, not if, but when the yield curve inverts, you're gonna see it all over the news, everywhere. When that happens, please watch this video again. The lead time of 10-year, 2-year yield curve inversions relative to recessions is quite variable. There have been 6 official recessions since 1978, and the average span between inversion and recession was 12 months, with a range of 6 to 22 months before recession.
But what's something that can cause a recession? Oil. Specifically spikes in oil prices. Here, we're looking at the inflation-adjusted Bloomberg crude oil price percentage change from its 2-year moving average. As you can see denoted by the yellow line here, only once in August of 2005 since the early 70s did the change move above 50% without a recession on its way or already underway. And yes, we did just recently exceed that 50% increase, though coming off extremely low prices over the past couple years.
And lastly, it's understandable why recessions cause investors to become anxious. Bear markets tend to be worse when recessions occur compared to bear markets without recessions. While this data goes back to 1900, the modern stock market is a lot different now. Generally speaking, those bear markets with recessions, the red dots, last longer and feature larger drawdowns than the green dots, the bear markets without recession. But even using data from just the past 50 years, it's the same story. with recession bear markets having an average decline of 32.8% versus 18% for non-recession bear markets, and an average length of 17.4 months for recession bear markets versus only 6.8 months without a recession.
While economic data has been generally weakening recently, which is likely to persist, a recession is not yet our base case scenario. But it is time to dust off the playbook, hence today's Recession Redux. This is a unique period with the Fed now having embarked on a rate hiking cycle, with inflation this high and economic growth expectations this low. The health of the labor and housing market offers some tailwinds against the headwinds of inflation and Fed policy, but bouts of equity market volatility and potential weaknesses are likely to persist. The recent stock market rally has had a better breath tone with more stock participating in the rebound, and sentiment remains gloomy, a contrarian indicator. However, given the unique uncertainties of the current environment, we're encouraging sticking close to strategic, long-term asset allocation using the principles of diversification and periodic rebalancing to navigate potential heightened volatility ahead.
We will continue updating our playbook in the weeks and months ahead. Thanks for watching.